In this video, we'll take a brief look at several concepts related to efficiency, effectiveness, value, and productivity measures. Management involves coordinating and overseeing the work activities of others, so their activities are completed efficiently and effectively. Efficiency is getting the most outputs from the least amount of inputs. It more concerns doing things right. So efficiency means doing something at the lowest possible cost. It more focus on the cost reduction. It also concerns with the present and more about following processes. On the other hand, effectiveness means doing the right things to create the most value for the customer. It more focus on the customer satisfaction, and effectiveness has a long-term strategy in mind to meet the desired goals. In this line of context, the one thing you need to keep in mind is that efficiency and effectiveness are related to one another. As many of you are already familiar with that, value is the core concept in business activity. It is related to both efficiency and effectiveness. It can be defined as quality divided by price. And efficiency relates to the term productivity. And a major focus of all managers is to maintain or improve the level of productivity at their work unit or organizations. So organizational effectiveness relates to the goal attainment. Every company must have a strong emphasis on the attainment of both efficiency and effectiveness. However, problem is that increasing production does not necessarily increase profit or revenue or sales. Production statistics do not include the value of the production and cost of achieving that production. It doesn't mean anything. Sure, they can show you if more productive, but that does not mean that you are more profitable. So you must consider the value and the cost of production. Productivity is simply some measure of output divided by measure of input. Business efficiency and profitability are closely related to productive use of labor. For this efficiency of business, there are two reasons to use labor productivity. First thing is labor costs are usually a significant part of total cost. And second thing is it is easy to measure. So when it comes to labor productivity, the simplest efficiency related measures relate to the productivity of labor employed by company. In order to remain competitive, a company needs to keep its unit cost down. So net income per employee, revenue, or sales per employee, these two measures typically refer to labor productivity. They measure management's ability to use their employee resources effectively to create profits for the company. When these two measures are in conflict, I would recommend choosing net income per employee, which is better indicator of measuring labor productivity. There are several ways to improve labor productivity by streamlining production processes, investing in capital equipment, training employees, and improving working conditions. In terms of asset productivity, there are typically three kinds of metrics. The receivable turnover ratio measures a company's efficiency in collecting its sale on credit. So receivable turnover simply represents a sale on credit. So we are essentially owed some type of money. We provide a good or service. We have not been paid though. We've given a promise to pay. So normally we provide a 30 days or so from the time that the transaction is finalized to when the receipt of cash comes in. And of course, if we are gonna be doing business on credit terms in order to be able to manage cash flow effectively. So we need to be able to convert those account receivable, which are technically listed as assets on a balance sheet into cash, because they provide us with no value until they become cash. So which of course we can utilize for payroll or inventory or whatever the case may be, whatever we want to purchase. So account receivable turnover measures the ability to collect cash from customers. So the low ratio could indicate credit policy that are too loose. When it's too high, this may indicate that credit is too tight, and that may cause businesses to lose sales to good customers. So, and then the formula is annual credit sales divided by average account receivable in a year. This ratio is not a percentage. It's meant to represent how many times we actually collect full account receivable in a given period of time. In this case, a year. But it depends on the beginning and ending account receivable number that you utilize as an example. Average account receivable is calculated by taking the beginning net account receivable plus the ending account receivable and dividing by 2. And higher ratio indicate that the quicker a company gets its customer to make payments, the sooner it has cash to pay for salaries, merchandise, and equipment, loans, and things like that. So from an operations and supply chain perspective, the company may be able to impact this ratio by such things as the speed of delivery of products, the accuracy in filling orders, and amount of inspection the customer needs to do. Another efficiency ratio is inventory turnover, which is one of the 3 key efficiency ratio to assess how efficiently business manages working capital. Inventory turnover means how many times a business replaces its inventory each year by turning it into sales. The formula is the cost of goods sold divided by average inventory value. The cost of goods comes from income statement, and average inventory you will get that from the balance sheet. This ratio measures how quickly the company is moving merchandise through the warehouse to customers. This ratio measures the efficiency of inventory management. It also measures the company's efficiency in turning its inventory into sales. Its purpose is to measure the liquidity or speed of inventory usage. So the high ratio indicates that the company is well managed. They move merchandise to customer faster. Therefore, they can generate cash faster. A high inventory turnover ratio implies either strong sales or ineffective buy. Just in this case, the company may be buying too often and in small quantities, driving up the buying price. If the number of inventory turnover has fallen, that might suggest a possible buildup of a slow-moving or obsolete inventory. So it could be a problem in business. And also, inventory turnover will vary depending on what kinds of business you are looking at. So for example, grocery market turnover inventory 20 to 25 times a year because there are lots of customers has taken inventory out whole time, whereas bookstore has a lower inventory turnover. And also another example is the lean production in the car manufacturing sector. Inventory low material components arrive on the production line at just what it is needed. So in terms of lean production, whole idea is a lower level of inventory and higher level of inventory turnover. I'm going to cover this in later class for more details. Next, take a look at the asset turnover ratio. This metric is also important for analyzing a company and requires both income statement and balance sheet. The formula is equal to total sales revenues divided by total assets of business. It will tell us a few things about the company. The first thing will tell us how efficient the company is in generating revenue from its assets. This ratio measures a firm's efficiency at using its assets like facilities, equipment, and technologies in generating sales or revenue. So the higher revenue is relative to the asset base, the more efficiently the company is run and the less capital is required to generate the revenue. By analyzing this ratio trend over time, we can see if the company is becoming more efficient or less efficient in generating revenue from its assets. In addition to that, by performing benchmarking and comparing the asset turnover ratio of the company in questioning to other companies or industry average, we can determine if it's doing well relative to what's normal or average in the industry. It also indicates pricing strategy. Asset turnover is more general and includes the plants, warehouses, equipment, and other assets owned by the company. Because many of these facilities are needed to support the operations and supply chain activities, the ratio can be significantly impacted by investment in technology and outsourcing. Thanks for watching this video. That's all for today. I hope you guys enjoyed this class. See you next time. Bye bye.